The US dollar has long reigned supreme as the global reserve currency, but it looks like the decades long dollar carry trade is starting to unwind with the potential to send shockwaves through US markets as $60 trillion dollars of foreign held investments in US assets starts to go back home. What is the dollar carry trade? How did we get here? Why does it matter? How big is it? And what are the implications? So, this dollar carry trade concept, I initially did this post several months ago, and a lot of people are familiar with the yen carry trade, but this one is way bigger, at least 20 times bigger, 20 to 30 times bigger than the yen carry trade, and yet not discussed as often, or especially at the time I made this post. I was basically the only one talking about this. Um, so, what is the dollar carry trade? Basically, what happened is in the 50s and 60s, but really kind of accelerating into the 70s, the US went around the world and encouraged the rest of the world to start using the dollar for uh, uh, transactions, right? As the unit of account for transactions in commodities and other business dealings, and even encouraged foreign banks to issue dollar denominated loans. This is kind of the euro dollar system, which is hundreds of trillions of dollars large. A lot of people know about the petrodollar system. This was basically the US getting oil transactions to be denominated in dollars, therefore requiring the rest of the world to buy dollars before they bought oil. So, what does this do? This establishes a floor in demand for the dollar. And given a constant supply, that pushes the value of the dollar up. And, as that dollar appreciates, US made goods become more and more uncompetitive. So we have to offshore and outsource our critical industries to the rest of the world. And the agreement was we will do that. We will ship you our factories and we'll buy the stuff from you. We'll run a trade deficit. That is the way that we get US dollars out to you. And then you will reinvest some amount of that back into dollar denominated assets. Remember, when people talk about the dollar, it's actually really dollar denominated assets. Stocks, for example, are S&P 500, SPY shares, ETF shares, QQQ. These are dollar denominated assets. What is really equivalent or synonymous is US Treasuries. This is really what people are referring to when they talk about the dollar. And the agreement was we will operate the deepest, most free capital markets in the world. And we will ask very little questions, have very little regulation, and attract. We will be the world's piggy bank, and you can recycle those dollars into our markets. Well, this was really great for the top 1%, for the banker class, for Wall Street, because hopefully it's clear that finance, financial services, right, all those kinds of industries do really well in this sort of system when tens of trillions of dollars are getting pumped into those industries. It was not so great for the bottom 90% who don't own a bunch of assets. And so this worked for foreigners, though. In addition to working for the Wall Street class in America and the top 1% here, it also worked for foreigners because not only does SPY, S&P 500, not only does that go up and to the right pretty much all the time, if you zoom way out, right, the thing is parabolic. Not only are you gaining on that, but we are also strengthening the dollar versus your local currency. So you're actually making money both directions, both on the currency side and on the underlying asset. This is called positive carry. This is really good, right? If you can borrow in a depreciating currency, say the yen, you borrow in yen, convert those yen to dollars. You know that the dollar will always appreciate versus the yen, so you're making money in that direction. You can pay that loan back with devalued yen, right, over time. But not only that, but you're also making money on US tech stocks, for example. And so it's really easy to pay back that loan in 5 years, 10 years, whatever the case may be. And so this worked really well for foreigners. They loved doing this. Um, but the problem is, the dollar had always appreciated for many decades, basically. If you zoom way out, the dollar appreciated on a trade weighted basis pretty reliably. And so foreigners didn't need to hedge that currency exposure. And so they didn't. And over $9 trillion of US stocks are currency unhedged, meaning those foreigners, if the dollar starts to go down, they are not hedged for that inevitability. They are only assuming that the dollar will always go up because that's what it's done for many decades. So they are currency unhedged on trillions of dollars of US assets. So, as an example, say you're a foreigner, a Swiss banker, and you buy the S&P 500 at 6,000 and say it just goes sideways for a year. You're still in profit so long as the dollar goes up, which it's done for many years versus the Swiss franc. But now imagine that the dollar declines by 20%. Even though the S&P is going straight sideways, you are now down by 20% because the dollar is depreciating versus your currency. Now imagine that not only does the S&P 500 decline, say by 20%, but the dollar also declines by 20%. Well, now you're suddenly down 40%. And this can be the exact opposite of a virtuous cycle. This can be a vicious cycle. That Swiss banker will now sell not only the S&P 500 but the dollar, and he will take it back home. So here's a concept I've talked about many, many, many times. It's called the interest rate differential. So what this does, you take the U.S. two-year government bond yield, the interest rate on the U.S. two-year bond, and then you subtract the yield or the interest rate that you get on the Swiss two-year government bond. And you get this red line. In white, you have the dollar Swiss franc exchange rate. And remember, the dollar is the numerator. So as this white line goes up, the dollar is strengthening versus the Swiss franc. And when the white line goes down, the dollar is weakening versus the Swiss franc. Well, hopefully it makes sense why there is this tight correlation. And this goes back many years, but just trying to illustrate when it all changed. We can see this tight correlation where as the two-year bond yield offers more yield, right? This red line is going up, meaning the two-year bond yield is higher, increasing faster than the two-year in Switzerland. You are getting more yield in the US. Well, it makes sense that capital will flow into the US dollar, pushing the white line up with it. And same goes in reverse. As the U.S. two-year yield starts to fall faster than the Swiss two-year yield, this red line will go down. Well, what do we see since so-called Liberation Day on April 2nd? We see a total divergence from this correlation. We see that U.S. rates are actually going up, right, faster than you are getting more interest in the U.S. as this red line goes up, but yet the dollar is weakening. So, what are the mechanics behind this? Why would this happen? So, say you're that Swiss banker and you own US two-year treasury bonds. Well, remember, when you sell those bonds, that'll push the yield. The yield is inverse to the value of the bond. So, as you sell that two-year treasury bond, that pushes the value of the treasury bond down and the yield up. But you're Swiss and you're getting dollars. When you sell that treasury bond, you're getting dollars. Treasuries are dollar denominated assets. If you're a foreigner and you hold US treasuries and sell them, you don't get some other currency, you get dollars. But you don't want dollars. So now you have all these dollars from selling your treasury bond, but you don't want dollars. You want to take your money home and buy the Swiss franc. So what do you do with the dollars? You have to sell the dollars. And when you sell the dollars, you're buying the Swiss franc. Every FX transaction is basically kind of two directions. You are selling the dollar to buy the Swiss franc. So they're kind of moving in opposite directions. And that's exactly what we see since Liberation Day. So now, once you have those Swiss francs, most likely you don't want to just hold currency. Again, going back to currency, when people talk about these currencies, they're mainly talking about bonds, government bonds. Say, so you're that Swiss banker, you don't, want to sell your two-year U.S. bonds and just hold currency. You want to hold Swiss two-year bonds. So the order of operations, you sell the bond, you get dollars, right? That pushes the yield on the US bond up. Now you have dollars. Okay, you take those dollars, you sell them to buy the Swiss franc. That pushes this white line down. Now you have Swiss franc. So now you can finally, in the last step in the cycle, you can buy the Swiss two-year bond. And remember, that pushes the yield down. So because this is a spread, the order that operation of selling the 2-year US 2-year bond to buy the Swiss 2-year bond, that would push this red line up as the yield on the US is going up because you're selling, and the yield on the Swiss 2-year bond is going down. That would increase this differential. And sure enough, post Liberation Day, that is exactly what we have seen. We have seen this tight correlation break and start to diverge where even though the US rates are moving higher, the currency is moving lower. And it's not just the Swiss. So here is the yen. Here's the dollar yen. And again, same exact concept. This is the 2-year US bond interest rate minus the Japanese 2-year bond interest rate. And you can see, again, very tight correlation as the interest rate on the US falls relative to Japan, the dollar weakens. And as the US starts to offer higher interest rates, the currency strengthens as money pours into the dollar so that people can then buy the government bond. And we see this correlation again. It's a very, very tight correlation. Well, what happens Liberation Day in yellow? It starts to diverge. We see kind of the first week after, and this is when I first started doing videos on this, that first week after Liberation Day, when markets were kind of melting down, we saw the US bond yields go up, but the currency go down. And sure enough, in the past week or two, when everyone's kind of freaking out about what's going on with Japanese bonds, we've seen the currency actually appreciate, right? The currency is actually strengthened. The yen has strengthened despite all the chaos that you have been told is kind of a crisis. Here is same exact concept, but in Europe. So in Europe, they have one currency, but each country issues their own bonds. So I created this kind of average of the average European bond yield. And we're looking at the same exact thing, which is the US 10-year minus that average of European 10-years. And we can see the same thing. So as the white line goes up, you are getting more interest in the US. And sure enough, this red line goes up. This is the dollar appreciates as money pours into the dollar. And the same goes in reverse. As the US offers lower relative interest, the dollar will weaken. Well, what happened since Liberation Day? Same exact thing. So the currency has weakened despite the US offering higher interest rates. Again, just the order of operations. You're European. You own US 10-year bonds. You sell those 10-year bonds, US Treasury bonds, you get dollars. But you don't want dollars, you want to buy European bonds. So you sell the dollars, put another way, you buy the euro, pushing this red line down. Then you buy European bond, whichever country you're in. That pushes that yield down, right? So the 10-year 10-year yield is moving up because you're selling your US Treasury bond, pushing the yield up, but you're buying the European bond, pushing the yield down. So this white line goes up. The spread will increase. Here's same exact concept, but with the Canadian dollar. And we can see the same exact dynamic, very tight correlation, right? As the US interest rate is higher here in red than the Canadian interest rate, the US dollar appreciates. And same thing in reverse, right? As the US 2-year bond yield goes down, the dollar will weaken. A very tight correlation. Well, then what happened on Liberation Day? This started to diverge, and we can see the dollar is weakening despite the US 2-year, the US bond yields actually being higher. Again, just the way that these transactions happen, this illustrates the same exact concept. So here is the dollar versus the Swedish krona. And same exact thing with the interest rate differential in white. And we see a very tight correlation that breaks on Liberation Day. We see the dollar weaken, right? This red line goes down despite interest rates in the US being higher. And here is the Thai baht. So this, I want to include emerging market or two. I think I have two. This is the Thailand currency, and they have bonds too. And we can see the same exact concept where the dollar weakens as the U.S. government bond is the interest rate versus the Thai interest rate. As the U.S. interest is lower, we see dollar weakness. This correlation isn't quite as strong, but hopefully you can see that in general, directionally, it moves in the same direction, right? As they move together, they move in the same direction together at the same time. The magnitude can kind of vary a little bit more, but in general, the direction of travel when U.S. rates fall faster than the Thai rates, you can see the currency, the dollar weakens. Well, the dollar has been weakening despite U.S. interest rates actually moving higher. Now, I think the reason that this correlation is not as tight is because if you think about it, how many government bonds Thailand is not exactly the richest country. This is not a knock on them. This is just kind of objectively, they don't have trillions of dollars of savings. And so they're not going to have as many dollar denominated assets like treasury bonds. So I think that this is probably why it's a little more noisy, a little more messy of a correlation. But the clear trend change after Liberation Day is higher US rates, but a weaker dollar. Again, same exact concept that we've been talking about. Here is another emerging market, Malaysia. And we can see the same exact concept with the US 10-year yield minus the Malaysian 10-year yield. As this goes up, the US interest rate is higher than Malaysia. And we can see the dollar, which is the numerator, strengthen. Same thing in reverse, right? As the US rate becomes lower than what you can get in Malaysia, the dollar weakens. Put another way, the Malaysian ringgit appreciates or strengthens. Well, what happened post Liberation Day? This went up, right? The US bond yields were going up. And despite that, the value of the dollar was actually falling. Again, it illustrates the same thing. You're a Malaysian businessman, you have treasuries, you sell the treasury, now you have dollars. You don't want dollars, you sell the dollar, pushing this red line down, and you convert it into your local currency. So now you have Malaysian ringgit. After you push the red line down, now you have Malaysian ringgit. Well, you want to buy Malaysian bonds. So you buy the Malaysian bond. That pushes that interest rate down. And remember, you just sold the US bond, pushing the interest rate higher. So that whole transaction would push this white line up. So here is what's called the net international investment position. There's two charts here. And what this is this is the difference between what U.S. Business people and the country in general, right? Individuals within the country, institutions. This is what U.S. owns of the rest of the world, right? We own some foreign bonds, we own some foreign stocks. The difference between that and what they own of our assets. And what we can see is that both of these charts are as a share of GDP. And what do we see? We see that, the US net international investment position, our GDP is about $26 trillion, remember. It has been on the same general path, which is, we had a positive net international investment position of about 10% in the late 70s. Well, when did kind of globalism and hyperfinancialization and the trade deficit, right? This might look very familiar. This looks, I always point out the balance of trade and the trade deficit. These two lines are very, very similar. And what do we see? We see the net international investment position get worse. We see foreigners are starting to own way more of our stuff than we own of theirs, right? And in fact, as of the most recent data that I could find, this is actually negative 100% of GDP, meaning the difference between what we own of their stuff and what they own of our stuff, the difference, not the gross amount, the difference between those two numbers is 100% of GDP. And we can see how that compares to other countries in the world. We can see these net exporters, right? Like Taiwan, Japan, Saudi Arabia, Sweden, they all run a current account surplus. They run a trade surplus. So, what that means just mechanically is that wealth, the rest of the world's money and wealth, is flowing into their country. Well, by the fact that it is a surplus, that implies they are not spending. They are not using that wealth for domestic consumption. It's basically just piling up as savings. And sure enough, that's what we see in these net exporters like Japan, Taiwan, Saudi Arabia, Sweden, Israel, China. They are huge savers. They have accumulated way more of foreign assets, right, than the rest of the world owns of their stuff. And that's the opposite. That is a positive net international investment position. And we can see Taiwan is by far and away the biggest with, I don't know, 160, 170% of GDP, just utterly off the charts. And then we can see, some net international investment positions negative, um, and the US down here at, like I said, the most recent day is 100%. We are by far and away, the worst off when it comes to this. And this chart just kind of illustrates that same net international investment position concept. This is from Jeffrey Gunlock, who's really great. Really appreciate all of his videos. This is from one of those. And what you can see is that in blue, that is what foreigners own of our stuff, right? And in that gold color, that's what we own of their stuff. And you can see that the gross amount of foreign holdings in U.S. assets is actually $60 trillion. And that is a lot of money. That is over 200% of GDP. But we own some of their stuff. And we can see in this chart that's $37.9 trillion. Well, when you take the difference between those two, what you get is the red line in the lower pane. That is the net international investment position. And again, this was published a couple months ago, maybe even a quarter or two ago. So it's not the most recent, but it illustrates the concept. And we can see that net international investment position has been falling. And I want to just, because I mentioned it, I want to show the balance of trade, so that hopefully, since you just saw the net international investment position, this balance of trade will illustrate what I'm talking about. So that looks strikingly similar to the net international investment position. As we run a larger trade deficit, right? It was kind of declining, if you recall, and then it really started to kind of fall off a cliff and start curving kind of exponentially. Well, that's exactly what happened with our trade deficit. We have been shipping $140 billion of our wealth off to other countries, and they are using those dollars to buy dollar denominated assets. So, what kind of assets do they own? So here we see the what's called the TIC data, TIC, and you can find this at TIC data, TIC data.treasury.gov. And what we can see is the breakdown of what they call foreign portfolio holdings. So I will leave this up on the screen, but what I want to point out is the pace at which this accelerated over the past, call it 5, 6, 7 years. We can see that it was generally speaking kind of increasing at a relatively slow pace, even as globalization was really kind of taking hold. China was admitted into the World Trade Organization in '01, which is really when globalization kind of started to really take off. And it was increasing foreign holdings of dollars as we ran ever bigger trade deficits. It was increasing gradually. But then what happened in kind of call it 2018, 2019, certainly by 2020, this started to really blow out. And we can see that as of 2024, foreigners held $16.8 trillion of US stocks. That's what equity shows. That is US stocks. They own $16.8 trillion of US stocks. And look at what the number was just 5 years before that. It doubled. So in 5 years, the foreign holdings of US stocks doubled. Now, again, we don't know what stocks those are. They could be national security companies like Lockheed Martin and Northrop Grumman. We don't know. They own $16.9 trillion of US stocks, and we don't even really know which stocks they own. Here's Treasury debt, and you can see a very, very similar trend. But it didn't double, right? In 2024, it was 7 trillion, and you go 5 years back, it was 5.5. So that is definitely not a doubling. We can tell that a huge amount of this foreign capital was going into stocks. Um, and that is really what kind of increased. Well, if you look at a chart of the S&P 500, it makes sense, or the Nasdaq, the tech stocks. Um, the important thing to point out here is that 9 trillion of that 16.9, so over half of that 16.9 trillion that foreigners own of US stocks, over half of it is currency unhedged, meaning there's no protection for those foreigners that own those US stocks if the dollar starts to decline. And of course, there's corporate debt here. There's agency debt. This is like mortgage-backed securities. So there's some pretty astounding implications of the fact that over $1 trillion of mortgage-backed securities are owned by foreigners. But we won't go there. You can use your imagination. But yeah, this goes through all the different assets, and it's really comprehensive. If you want, you can find this document or look at it as I kind of scroll through. But generally speaking, as a trade deficit has increased, foreigners must recycle. The other way to think of a trade deficit is it as a capital account surplus, meaning that we must have investment in our financial markets to offset, or you can think of to pay for in some sort of way, to pay for that all that wealth that we are shipping out to other countries. It needs to be financed. Um, Capital account surplus is one of the ways we finance that. The other way, one of the main ways actually, is the fiscal deficit. So we run deficits, right? This is the twin deficit. We run deficits, and foreigners recycle. We are sending dollars, sending our wealth to foreign countries. They need to be able to buy stuff with those dollars, $140 billion per month. And so by running a fiscal deficit, we that is one of the ways we are creating treasury debt to sell them, right? So this is in my opinion a pretty broken, pretty crazy system that we have been running for many decades under both parties. And I would think that any party, any politician that seeks to that understands the national security implications of this, and seeks to address it. Anyone who tries to do that will have my support. But what this means is potentially, if this has started, if this is part of a larger trend, we are in for much weaker dollar and much stronger foreign currencies. This is part of my thesis for why the S&P 500 might do okay in nominal terms, but similar to Julian Brigden, I have been predicting foreign market outperformance versus the S&P 500 since like December of last year is when I really first started talking about this. And I still stand by that. I still think that this administration needs a weaker dollar. Remember, the dollar is grossly overvalued due to all that demand around the world for the dollar. That pushes the value of the dollar up way past what it should be. Because remember, we run a twin deficit. So, on a balance of payments basis, the dollar should be much weaker because we run a twin deficit. On a balance of payments basis, if the dollar is valued fundamentally, fairly, it would be much weaker. Well, what would that much weaker dollar do? All of a sudden, I mentioned in the beginning, a strong dollar means that it is difficult, basically cost prohibitive, to make anything in the US and sell it to the rest of the world. So that weaker dollar might sound bad, but again, remember, I'm not talking about the kind of purchasing power of the dollar in the US economy. I'm talking about two currencies, the foreign exchange rate of the dollar, which, in this example, if you are not traveling to Canada or buying Canadian goods, which is, lumber and oil, right? Maple syrup. If you are not traveling there or buying goods directly from Canada, this currency, this quote unquote weakening of the dollar, does not really affect you. The what really affects the vast majority of Americans is the purchasing power of the dollar. And that is determined by the Federal Reserve and the Treasury and the government, right? Running insane deficits, money printing, inflation. What most Americans have felt over the past 5 years, the kind of collapse in the purchasing power of the dollar, that is not caused by any of this, right? Any of the stuff we're looking at. In fact, the dollar actually appreciated during the past 5 years. The DXY, and I will show that, the DXY went up during that period of time where your purchasing power was collapsing and inflation was, in many ways, um, higher than 20%, cumulative. The dollar was actually appreciating. Look at that. So again, hopefully that illustrates that when I talk about a weakening dollar, I'm talking about the foreign exchange rate, not the purchasing power of the dollar in the way most Americans think of it. This really, is not synonymous. How did we see the dollar index, right? The foreign exchange rate of the dollar. We saw that strengthen dramatically, despite the fact that if you're an American, inflation was like over 20, 25% cumulative over this period of time, but yet the dollar strengthened. So hopefully, don't when I say the dollar weakened, it does not equate to what we felt the past 5 years. Now, there is a caveat, which is because we have relied on so much of the rest of the world to provide us with goods, there will be inflation there. If the dollar continues to weaken, anything bought from those foreign countries will go up in value. But the other side of the coin is that that thing can eventually be made here in America, employing American workers with high-paying jobs and strengthening the domestic economy. Now, that does not happen overnight. That takes 5, 10, 15 years. But I think that this is kind of the broader agenda. I think that tariffs are kind of a distraction. I think they're important, but I think they're kind of a general distraction for what the administration really needs. Tariffs alone are not going to balance our current account deficit. They need a weaker dollar. And sure enough, what have we seen? We've seen a weaker dollar. So since he was, brought into office, this current administration, the dollar that was basically the peak of the dollar, the inauguration, and since then the dollar is down 9.4%. And inflation, by the way, CPI inflation has actually gone down and hit the lowest level in 4 years. So, again, hopefully, really try to separate the two concepts of foreign exchange value of the dollar versus purchasing power of the dollar in your normal life. They are two totally different things. And the other implication is not only a weaker dollar, meaning it is returning to fair value, which is much lower than it is now, even. Not only that, but if $9 trillion, remember, foreigners own 16 trillion of equities, right? Of S&P 500 and Nasdaq. If that money starts to rotate out, that will be extremely negative for U.S. stocks. And it's important to point out, what do you think? Generally speaking, it's agreed upon that foreigners own all the momentum stuff, right? So the NASDAQ, tech stocks, the MAG 7, all those momentum factors, that's generally speaking what they own. And so, I can't give financial advice, but take this video for what it is. It's a bit of a warning for the potential of this. We are clearly seeing it has started. Now, whether it continues is a different story, of course. But this is not a theory. This has already started. And in fact, it started even before April. I've pointed out many times that I started talking about this in January or February. I started to notice signs of this happening then. So this, goes even before Liberation Day. And in fact, like with the euro, I will show that here. This goes back years. This goes back many, many years. With the US rate actually moving higher, what do we see? I will clean this chart up. What do we see with the euro or the dollar euro? So the US 10-year bond yield is actually moving higher, right? And it's in this kind of upward channel. And this goes back to 2015. So the 10-year bond yield in America is moving in an upward channel. Well, what's been happening with the euro? it has been moving down and much more kind of sideways. So it's a very subtle trend change, but that what that indicates is on the margins, this has already been going on for many years, long before this current administration. Now, again, it's a much more gradual thing. You have to really kind of uh, look at it closely to see this upward trend here. This goes back to 2023, by the way, long before this administration. But this kind of downward trend in the dollar, right? Even though generally speaking, yields are moving higher in the US relative to Europe. So this is part of a broader shift. We really haven't ever seen this large of a kind of disparity in terms of net international investment position. It could have really dramatic consequences if it happens quickly. But I think what's much more likely is it'll happen slowly, and just kind of be a headwind for U.S. Based assets. Now, as a younger millennial that doesn't own a home, my hope is that this also kind of drags housing prices down. We desperately need that for the younger generations that have worked really hard. And yet still can't afford to own even a starter home. So I hope that this has some positive impacts, but just at least hopefully this was educational. If you want to take it as a warning, hopefully it helped inform a view for your investment decision. Again, not financial advice. This is just kind of going over some data that I think is noteworthy, and not a lot of people are talking about this. And so I thought it was helpful to maybe explain it in simpler terms, so you don't have to try to decipher the macro babble from the very smarty pants macro guys. So, anyways, hopefully that was helpful. I'll catch you in the next one.